economics. So far we have discussed about expenditure method. In the previous session, what did we discuss? We discussed about the expenditure method, and we are in chapter 2, which is national income accounting in macroeconomics, right? We are not going into Indian economic development right now. We are going to finish macroeconomics and then we will be going into the next part. Okay, I hope that you all are watching all the videos to understand the topic. Expenditure method, we have discussed how to calculate the GDP, right, gross domestic product, how to calculate with the help of value added method and with the help of expenditure method. In expenditure method, we talked about final expenditures of what? Final consumption expenditure, final investment expenditure, final government expenditure, then the total export revenue minus the import expenditure. That is how you calculated the GDP, that is the national income. Whereas in the value added method, how did we calculate? We calculated using GVAI, that is what? The gross value added of firm I. That is how we have calculated with the help of the expenditure method and the value added method. What are we going to do next? The third method of how to calculate your national income is the income method. Okay, what is the third method? We are going to talk about the income method. Income means what? Earnings. Okay, so earnings will be in forms of wages, salaries, rent and profit. Profit, how come wages and salaries? Of course. Then what is the difference between wages and salaries? Wages means daily wages, salaries means for month. Okay, whereas when you talk about the interest also that you receive on your capital, when you invest something, you receive an interest on the capital. That even is considered to be an income. And then what else? We are talking about the rent that is received by you, not paid by you, received by you. Whatever you receive in terms of money is called as an income. And what is the next thing? We spoke about profits. Profit is also earning, right? Profit is a remuneration for taking risk, right? So as businessmen we take risk. And mostly here everything we spoke about firms, firm I. We spoke about firm I. Here what are we going to do in the income method? Income method is going to be basically for households. Households means families, okay? Households. So we are going to mention that by N. Right, there we mentioned as N. Right, N number of one. Here we are going to mention M, that is the number of households in the economy. Now how is income method defined? Or how is net domestic income defined? Gross domestic product, national income is what we are going to calculate, right? How is it determined? It's the income generated in the form of what? Wages, rent, interest and profit. Okay, what are the things that you add up in your form of income? Wages, the rents that a household receives, interest that they receive, profits. All these are called as income. They all contribute towards the income. And what else? In the domestic territory, it should come within the country. Within the country, domestic territory of a country by all producers in an accounting year. Now, why are we saying all producers? Because in macroeconomics, we see everything in the aggregate term. We talk about the aggregate value, right? That is why we say all producers. And what is one more important term? The domestic territory. Okay, whatever comes, whichever firm comes within the domestic territory, we take that into account for net domestic income. So what are the things that you are going to take? What are the factors? Wages, rent, interest and profit. What do you do in value added method? In value added method, we spoke about the intermediate goods. We reduced the value of intermediate goods that we have used and then we have found out the GDP. But whereas in the expenditure method, we added, right, we totaled all the expenditures that we have spent towards a product or service of a particular firm that we mentioned as CI. Right? You remember we mentioned it as CI. Now this CI we took it as sigma I is equal to 1 till n CI is mentioned as C. Okay, that is what we have written as C. Same way only for investment, government expenditure, export revenue and for import around these terms are different. Now what are we going to do? We are going to discuss entirely about the income method. What is it basically? How do you calculate that? That is, gross domestic product should be calculated on the basis of the income that a firm pays for producing its products and services. Okay, so what it is? It should be equal. The sum of final expenditures that you have incurred should be equal to all the income that is received by the factors of production. Okay, that is what it should not. Final expenditure is the spending on final goods. It does not include spending on intermediate goods. Final expenditure means what? We will deduct the. It will not take into account about intermediate goods. Talking only about final goods. So what are the factors that is involved here? We speak about salaries, wages, rents, interest and profit. Okay, all this that is received by a firm, by all producers in that particular economy. Okay, and M is what? M is the number of households in the economy. M must be total number of households in an economy. Right, what does it lead to? It leads to a new expression. Already we have two equations. We are going to have another equation now, which is going to be 2.5. That is, how is GDP calculated on the basis of income method? How is it calculated? What are the things that we are going to take into account? Wages. How are you going to mark wages? You are going to mark wages as WI. Alright, we are going to mark interest as interest as IN. Why IN? Because I here stands for investment also. So to differentiate investment from interest, we have made it as IN. Okay, then rents are there. That is going to be your RI. Salaries are going to be your SI. Profits are going to be your PI. Alright, these are the notations that we are going to use to form the equation to find how to make up the total income that is earned. That is the GDP. What are you going to do? You are going to add the wages, profits, the interest and the rent. Okay, salaries and rent are coming under the same thing. Even though you say it as S1, salaries and wages are considered to be 1. Okay, so how are we going to calculate it? GDP identity. Okay, sigma or summation. Okay, I is equal to 1 until what? Till M. Until when M, what it is going to be? First you are going to take wages WI plus sigma I is equal to 1 capital M. Then what? Profits PI plus next is sigma I is equal to 1 capital M. Then you are going to have interest rates IN, I. And then finally rents. I is equal to 1 capital M R I. Okay, this is going to be your GDP. But here now we have given it in short terms. Here also we would like to have it in short term. How are you going to have have it in short terms. Set GDP identity. This entire term is there, right? Sigma mi is equal to 1 capital M W I. How are you going to write it as? You are going to write it as capital W plus, then this is going to be written as capital P plus, this is going to be written as capital I N plus, this is going to be written as capital R, and this is going to be your equation 2.5. Okay, what you have done? You have added, you have brought the wages, salaries and wages, profit, interest, and then what? Rents earned. By adding this, what will you get? You will get the GDP, the national income. Clear? You have brought it down just the sigma value. Instead of that sigma value, you have just written it as in capital terms. Now what are we going to do? We have 3 GDPs we have. 1, 2, 3. We are going to bring this 3 in the same equation. How are we going to do that? GDP, identity. Everything is identity, okay? What it is? Sigma I is equal to N. Sorry, I is equal to 1. Capital N. GVAI. What is it? Gross value added of firm A plus, sorry, not plus, identity. Isn't it? It's all same, no? Which one you are going to take? You are going to take this one. That is C plus I plus G plus X minus M. Okay? What again? Identity. This next one. W plus P plus IN plus R. This is your equation 2.6. What you have done, you have brought everything together in the same line. That's it. Only once you have written GDP and identity symbol. Using identity symbols, you have brought it into the same thing. One is the value added method. Next one is the expenditure method. Third one is the income method. Okay. And what here? This I stands for both the planned expenditure and unplanned expenditure. Right. So they have given you one more small tabular column where this is written in a diagrammatic format. That's it. What are we going to do next? We are going to refer to an example and see it in terms of numbers. Okay, so that you will be able to do your own problems. In today's worksheet, I have given you a problem. Kindly work it out. In the next video session, we will be discussing the same problem. I will work it out and show it for you. Okay, but I want you to try it today. Okay, children? Refer to the book and try. What is the example that is given here? You have 2 firms. Okay, what are those 2 firms? A and B. And A uses raw material and produces cotton worth 50 rupees. So we are going to see in each method what is the value added method, expenditure method, and finally we are going to have the income method. First we are going to do the value added method. Value added method, you know what you have to do? You have to have a tabular column, right? So when you have the tabular column, we have firm A and firm B. Alright, and what is the sales that is happening here? Let me read out the example first. 2 firms. Suppose A uses no raw material and produces cotton worth rupees 50. Cotton worth rupees 50. A sells its cotton to firm B. The sales of firm A is 50 toward firm B. And what happened? Who uses it to produce cloth? And B sells rupees 200. So the sales here is 200. What we have to do? Intermediate goods we have to see, right? Intermediate goods. Did firm here use anything? No, they didn't use any intermediate. But whereas here they have used 50 rupees worth. That only they have bought, right? So what will you do when you are finding the value added? The value added becomes the same 50. And here it becomes what? 200 minus 50? 150. This is how you calculate the value added method. Okay, that is the 150 will become the final thing. Income. The GDP. That is what you have done in method 1, which is the what method? Value added method or the product method. What is the second method? Expenditure method. What are we going to take into account here? The expenditure. GDP in the phase of disposition or in the expenditure method. How do you do it? GDP is equal to final expenditure. Sum of final expenditure. Consumption expenditure, investment expenditure, government expenditure, export revenues, import value. Right. Here what we have given final expenditure is expenditure by the consumers. That is for 200 rupees they have bought the clothes. Consumption expenditure only is given here. They have not given you about the investment expenditure or government expenditure. So here in expenditure method the GDP will be 200, which is what? It is the consumption expenditure. Why is it the consumption expenditure? Because consumers have bought. During sales only they bought this 200. So GDP becomes 200. Because of consumption only they have bought this 200, right? So that is the GDP according to which method? The expenditure method. Finally, we are going to find out the GDP in what? In the income method. How are we going to do this? So we are going to look about the firms A and B. What are we going to do? We spoke about wages. We spoke about wages, profit, interest and rates. But nothing is told in the example. So we are going to assume something more. What are we going to assume? 50 received by A. The firm gives rupees 20. Out of this 50 rupees is there, no? In this 20 rupees is given to be workers bonus or workers wages and keeps the remaining 30 as profit. So how they have divided this thing? 20 plus 30. That is 20 rupees is what? Wages and 30 rupees is what? Profit. Clear? Whereas B gives 60 rupees as wages plus 90 rupees as profit. Clear? Out of this 150 that they are receiving, what they are doing? 60 rupees as wages and 90 rupees as profits they are keeping. Because of that only you get the GDP. Clear? Now what you are going to do? You are going to have another tabular column here. What are those? Firm A, firm B, wages and profit. Firm A, firm B, and what did we get? Wages. Wages, how much they have paid? 20 rupees. Whereas profits are 30 rupees. And for firm B, 60 rupees is paid as what? Wages, and 90 rupees is kept back as profit. This is their tabular column. Now what are we going to do? Income method. According to the income method, sum total of all the factor incomes, which is the total wages received by workers of A and B. 20 plus 60. What is 20 plus 60? 80. Okay. And what else also you have to add? You have to think about the profit also. And what is the profit? 30 plus 90? 120. So this is the total of wages. That is factor cost. Wages plus profits, which is 120. So here the GDP becomes 200. Clear? In second method expenditure method also the GDP was counted to be 200, whereas in income method also it was calculated as 200. Only in value added method it is different. You can substitute it with different values also, still it will be the same answer. Okay children. So this is how you calculate GDP using all the three methods. There are some extra information that I have to share with you. These are not given in your book, but still these I feel that it is valuable information for you to know about the income method. So I am going to discuss that with you. I hope you have understood how to calculate GDP using these three methods. This is what the value added method. The second method is the expenditure method. The third method is about the income method. Whatever incomes that we have heard, the factor cost is also added here. That we have calculated the GDP, which is 200. Clear? What are we going to do? In income method, how do you calculate it? What are the steps you need to calculate income method? First, you have to find out which are the enterprises that involve the economy towards this particular process in the production of goods and services. Okay? What do you have to do? You have to find what? Enterprises using whichever is using factors of production. What do we mean by factors of production? The wages that we are paying, right? Wages we are paying, we are getting profit, interest rates and all those. You have to find out. Then classify factor payments into various categories you have to do. Then you have to estimate the amount of factor payments. Then you have to find you have to sum up all factor payments, and finally estimate net factor income by minusing or adding abroad. From abroad, what is the value? What is the income that you are getting? Okay, plus from the domestic firm, the abroad and domestic firm you have to add so that you find the total income. What are the precautions or what are the things that you cannot add in here are things like only productive service should be added. Like for example, you cannot add pension, old age pension cannot be added as income, and unemployment allowance also cannot be added as income because you are not working there. Both the cases you are not working. So there should be some productive service should be rendered. Only then it is considered to be an income method, and that only can be taken into GDP. Here you have taken only wages and profits. And you did not talk about the pensions. Every company will give pensions, no? Have you added that here? No, that are expenses, but you don't add it in the income. Clear, children? And then sale and purchase of second-hand goods. That is, it should be a fresh production from your company and it should be sold. From that you have to get something. For that you are paying something as wages, then that can be considered as income method. But you cannot talk about the goods and services that you have, sold, purchased or sold for second time. Then income from illegal activities cannot be added in GDP, smuggling, all those things cannot be added. Finally, taxes are there, right? Wealth tax, which are not concerned with the products. Okay? Which are not concerned with the products like wealth tax, gift tax, sales tax, excise duties and all those things. Whereas the tax is, you add the value, GST value you are adding, right? That can be added. But the taxes that does not concern with the production, then you cannot add those taxes in the GDP. You cannot take it into account. Clear? This is the income method. Clear, children? What are we going to discuss next? This is a small little topic which is called the factor cost, basic prices and market prices. What do we mean by this? What do we mean by factor cost? What do we mean by basic prices, and what do we mean by the market prices is what we are going to discuss now. Factor cost, basic prices and market prices. Why do we have to know this? Because we should know whether to add it in GDP or not. Right, that is why we are going to know about it. So here GDP and factor cost. There is an important term called GDP and factor cost. What is that? You have to know one more office that is called as the Central Statistics Office. You would have read statistic in class 11, right? So Central Statistics Office of the Government of India has been reporting GDP. Statistics means what? They will give you facts, economical facts. They have been giving GDP at factor cost and market prices. But from January 2015, when the revision came, children? January 2015. What is happening after January 2015? The CSO has replaced the GDP at factor cost with what? GVA, the gross value added with basic prices. That is why we are going to discuss about these. What are they? Instead of GDP at factor cost, we have brought in gross value added at basic prices and GDP at market prices. Okay, that's why we need to know what are factor costs, what do we mean by basic prices, and what do we mean by market price. That's why we are going to deal with this small little topic. Okay, what is GVA? We discussed it already. The value of total output produced in the economy less than the value of intermediate goods. You have to minus what? The value of intermediate goods. You have to take the total value of production minus the intermediate goods. That is called the GVA. Okay, and what is meant by factor cost, basic prices and market prices? What is the distinction is that between net production taxes. What do we talk about? The net production taxes and net product taxes. We need to know the difference between net production taxes and net product taxes. What is meant by net production taxes? It means net production taxes. Production taxes less production subsidies, and net product taxes means what? Product taxes less product subsidies. Production taxes and subsidies are paid or received in relation to production. It is what? It is related to production of goods and services. But whereas, what is next? Product taxes. Product taxes and subsidies are paid on the other hand or received per unit of product. That is at the end product. Okay, this is about the production process, whereas this is the final good. Here excise duties and all will come. Do you think we will add excise duties? I said already, we don't add excise duties in GDP. Clear? So that should be excluded from GDP. What should be excluded? We should exclude the net product taxes. That is the excise duties of any kind that is levied on the final goods. But do we have to take the production taxes? Yes, we have to talk about the net production taxes because it comes under the production. Okay, it is in the process of production itself. Fine. Factor cost includes what? It includes only the payments to factors of production and it does not include any tax. So factor cost means factor cost is paid only to the factors of production. Salaries and wages. Salaries, wages, interest rates. Okay, factors of production. What is next? In order to arrive at the market price, we have to add to the factor cost what? Total indirect taxes less total subsidy. So how are you going to find out the market price? By adding the indirect taxes that is levied there. Production, whatever tax is levied, that is added in the price. Right, that is what is added and then only you derive by what? Market prices. Okay. Factor cost is only for factors of production. That factor cost plus the indirect taxes will be market prices. Clear, children? What else? Therefore, in order to arrive at market price, what you have to do? We have to add product taxes to the basic prices. Product taxes to the basic prices will get you the market price. A product is made for 20 rupees, but the taxes come up for 5 rupees, means then it will become the market price 25 rupees. Whereas what you pay for the factors of production is different. What is the surplus called? Sometimes it is paid for tax, more than that if you get only, it is called as a profit. Okay, nowadays what CSO is doing, it is releasing GVA and basic prices. It is talking about the gross value added at the basic prices. That it includes the net production taxes. What it does? It includes net production taxes, but we do not talk about net product taxes. We don't add net product taxes in the GVA. Okay, so GVA, how do you calculate GVA at factor costs? GVA means what? Gross value added GVA at, what did we see first? Factor cost. Factor cost plus what are you going to add? You will add the net production taxes. Net production taxes gives you what? It gives you the GVA at basic prices. Basic prices. Then what do you do with this GVA at basic prices? When you add the net product taxes, GVA at basic prices plus net product taxes. Product taxes means what? The indirect taxes. The final goods. Product taxes becomes your market price. But what is the government? What is the CSO releasing? It is releasing the GVA at basic prices. That is, it does not take into account the net product taxes. It includes only the net production taxes. Clear, children? So far we have discussed about the income method, and with this we have discussed all three methods. What are those? Gross value added method, or the product method, then the expenditure method, and then the income method. We have seen an example relating to all the three methods and how we are to calculate it. We have discussed about factor cost, basic prices and market price. Factor cost is what? For paid for factors of production. But how do you find the basic prices? Basic prices will be found out by adding the factor cost with the net production taxes. When you add factor cost plus net production taxes, you get the basic price. When you add basic price with product taxes, net product taxes, you get the market price. Those are the three terms that we have discussed now. Alright, children, I hope you have understood. I have given you a problem in the worksheet. Kindly go through it, try to work it out. It is a very simple problem. Then we will be discussing the same problem in the next session also. But still I want you to work it out. Keep it ready when you are watching the video, so that it will be helpful for you to refer whether you have done it in the right way or not. Or you can assume yourself like what went wrong, so that you can correct your mistake in the next time. Clear, children? So thank you, and see you all in the next video session. Have a nice day.